Welcome back to Lamb's Cryptoverse. And yes, there's someone's birthday. Yep, there's no more privacy anymore. So today we're going to discuss the labor report. And I know you all saw that, you all know what it was, but what I'm going to do, and hopefully this adds value to you, is tell you how to interpret it. So let's get started. I'm going to talk about it briefly because you know it already. As you know, it's November 4th and the September report came out. It's October. October report came out and it was sharply higher than expected. 261,000 jobs were created and roughly about 205,000 jobs were estimated. So this is significantly higher than expected. And average hourly earnings were up 0.4% and less than that was expected, a hair less than that. And unemployment rate went up from 3.5 to 3.7%, but that's because of participation rate. And the labor growth is still pretty high. It was plus 4.7%, but at least that was the lowest since August of 2021. The problem is the productivity, which no one talks about anymore, is too low. And everyone talks about, including myself, the benefits of all these SaaS. Remember, SaaS is sexy, these cloud software / Kathy Woodstocks. And these businesses are supposed to be helping us with productivity, right? And then we've got Amazon Web Services and Azure. But despite all that, productivity has been too low. And as a result of that, we've got unit labor cost rising. And that's what you call cost push inflation. And the other issue is the economy is a service one. So it's dependent on people working rather than machines and robots. And as you know, wages have been going up for a while now, and wages are sticky. Like, think about it. Once you give someone a raise, I'm not sure if you own a business, but once you give someone a raise, what are you going to do? Take it back? It don't work that way. So the only positive thing about labor growth I can say is that even though it was strong at plus 261,000 jobs, it was the lowest since December 2020. But that's not really good enough because before that, we were losing jobs. The point is, the labor growth is way, way too high. And unemployment rate, again, is 3.7%. We have to almost double the unemployment rate in order for the Fed to accomplish its goals. Because remember, the Fed waited like a year too late to raise interest rates. So that's pretty bad. So how did the market interpret this? At first, stocks were down. Then they rallied late in the day. But frankly, I think it's because the Chinese stock market was strong because they're thinking they're not going to have a zero policy anymore. And so growth stocks, some growth stocks were up, but a lot of stocks just bounced off from the lows. I think it was very technical. If you look at interest rates, and this is what surprised me the most, short-term rates actually went down a bit, and I thought they would have gone up a lot. And what really worries me is the 30-year rate rose sharply. And the 30-year bond, the Treasury bond, was down 1 point. And that was the worst out of all the tranches. If you look at the yield curve, the 30-year did worse, was the worst performer compared to the 10-year, the 7-year note, the 5-year note, the 6-month, yada, yada, yada. So that's a pretty bad thing. So here's where I'm going to try and give you some value. So what does all this mean? Because sometimes it's conflicting, right? For example, I said labor growth at 4.7% was the lowest since August 21. And I said that in terms of number of jobs created, that was the lowest since December 2020. But it's not low enough. So what does this mean? I expect during the Fed's next meeting, I think it's FOMC meeting is December 14th, I expect with confidence that we should have at least a 50 basis point increase in the Fed funds rate. And if economic data keeps coming in strong, I expect it to be a 75 basis point hike. And I know that's unexpected, but things don't look good. So I'm looking for a 50 basis point hike in the next Fed fund rate as a base case, and then a 25 basis point increase thereafter. So what does this mean for stocks? After this short-term bounce back, there's going to be a lot of pressure on crypto and long duration assets and stocks because the Fed has to keep raising rates. They have to break the economy. Well, thank you all for listening, and talk to you next week. Bye.